Welcome back. With the budget knocking around consumer confidence and fund managers saying the stock market looks fully valued, how do we play stocks for the rest of the year? Roger Montgomery of Montgomery Investment Management shares his view on the subject. How are you, Roger?
Peter, I'm delighted to be here again.
You're very serious tonight. Sometimes you come looking...
I had a chat with Simon at stage left, and Simon was telling me about some of the good work he's doing in some charitable endeavours that I'll let him talk to you about when he feels like it. I was really impressed, and it was sobering. Yeah,
we do bring good people on the show, as you well know. The budget.
Yes.
Yeah, broken promises, people lamenting Tony Abbott breaking promises, blah, blah, blah. What do you think is going to happen to the stock market as a consequence of the budget?
Well, it'll do whatever it does after every other budget before the next budget. You know, there's a budget every year, and I think what's interesting about this particular budget is that there's been some interesting political consequences which might make it harder for a lot of the proposed legislations to get through the Senate.
Yep.
And so I'm taking a fairly pragmatic view about it, ignoring it, and focusing on individual businesses.
Yeah, that's what you often do. The one big order issue I figure is, if this budget is perceived by the Reserve Bank as being toughish, they might keep interest rates lower for longer.
Interest rates will have to stay low. Yeah. Interest rates will have to stay low for longer anyway, because as I've said on this program some months ago now, the real growth in China is actually closer to 5%. In fact, it might be less than 5% than what's being reported, and that's going to have serious consequences for demand for iron ore, steel, coal, and that's going to affect Australia. So interest rates will stay low for longer. That means if in the absence of inflation and low interest rates, in the absence of those things, then the reality is you get asset inflation. And so property goes up, stocks go up, and that's what happens. Now, you mentioned in your introduction that the stock market seems overvalued. I actually think it's fairly valued.
Yeah, I should have actually said that.
Maybe you did. I'm sorry, I might be
fully valued.
Fully valued. Yeah. Fully's got that connotation that, all right, I've had enough now, I'm going to stop.
Yeah.
And I believe that based on the quality companies that we look at, we think aggregate valuations are about 6%, market valuations are about 6% over the quality businesses that we own. So it's about fair value.
Yeah. And if we get stronger than expected growth, if we do, and earnings improve as well.
Earnings growth is important. We had this debate.
I know.
Last two visits, there's no correlation, Peter, between economic growth and the stock market.
But there is correlation between some companies and economic growth.
Company growth. Correct.
Right. Okay. Move on.
Yes, let's do that.
This comes a question from Harry. And I thought this is a critical issue because a lot of people are coming to me worried about these big order crashes on the stock market. So Harry asked, I was speaking to a gentleman that used to be a director at one of the 4 big banks. He mentioned to me that if Australian house prices had a 30% fall in value, our banking system would resemble the banking system of Europe. Whilst he believed that our housing values would not fall by 30%, I must admit it sent shivers up my spine as I own all the banks in my portfolio. After most commentators have indicated that the banks are overvalued, my question remains at the back of my mind, what happens if the unthinkable happens and there's a 30% fall? Roger.
Okay, so how do you get a 30% fall in property prices, Peter?
Lots of unemployment, I think.
Lots of unemployment, people who can't afford to pay their mortgages. Those at the highest risk of being able to not fund their mortgages typically take out higher LVRs because they haven't got enough money to buy the house, and so the loan-to-value ratio is much higher.
They rely on Genworth, which listed this week.
They're insured. The banks offset that risk with QBE and Genworth. And so Genworth and QBE take a large part now of those losses. Now, if we do get widespread unemployment across the economy, then yes, you might find house prices do fall. But I think the riskiest part of that market has been offset. The risk associated with that has been offset. Now, this gentleman who's written, Harry, he owns all the banks. That is very, very common in people's portfolios in Australia. But if you have a look at the intrinsic values of the banks, for the Commonwealth Bank, it's tripled in 10 years. For the NAB, it's gone nowhere in 10 years. The National Australia Bank's intrinsic value today is exactly where it was 11 years ago, and guess what? So is the share price. It hasn't changed in all that time.
Okay.
So I would be more selective about which businesses I owned, and I wouldn't own the NAB because we don't think it's a high quality bank.
Now, tell us why. Because from my point of
what
view,
happened?
Because NAB actually made some courageous decisions. They broke with the other banks.
Well, why didn't that continue, Peter?
Yeah.
What happened? That was a very successful campaign.
Yeah.
Why did it stop? There is a rumour, it's just a rumour, that some very large shareholders were worried that that would shake things up and approached the NAB and said to the NAB, you need to just come back into line, please, and don't shake it up this much. The status quo is stable and everyone makes money. Let's just leave it as it is. But the NAB, its intrinsic value hasn't grown. So why is that? They overpaid for acquisitions in the UK, and they didn't get the returns out of those acquisitions.
Now, this is the chart on the screen at the moment. But if you bought it at the right time, Roger, when it got down to like 22, it's been a very good investment, hasn't it?
Lots of people tell me that when I show them a 10-year chart and I say this company's added no intrinsic value. They say, but I could have bought here and I could have sold here. Bought at the bottom, sold at the top. My response is always the same. But you didn't.
Yeah, that's right. Of course. but I guess this is the important point. This intrinsic value calculation of yours hinges on a number of assumptions, doesn't it? And those, or parameters, things that can change.
Parameters, yes.
Now, my personal experience with a lot of the NAB executive team is that they are unbelievably proactive, even compared to the rivals. I know bankers from all across the country, and I'm wondering...
Not having value makes you hungry.
Yeah, that's right.
You want to achieve.
But my question is, how does your intrinsic value calculations actually take into account that maybe the management team...
Through the profitability of the decisions that they make.
That's right. But that's all in the rear vision mirror. What if...
Oh, no, it's not. We're looking forward.
Okay.
We are absolutely... We model every single company... And we meet with management. We model every single company that we're interested in.
Okay. So there is a qualitative aspect.
There's 50% quant and 50% qualitative.
Yeah, okay.
So the quantitative part throws up the companies that we're interested in looking at more deeply.
Right.
Then we go and talk to management, or they come to our offices, and we see many companies. Not as many as some managers, because we don't need to. We've got a smaller universe that we're interested in.
Okay. And historically speaking, even though you're close to deity, occasionally you would make mistakes in a sense.
Of course, everyone does. And by the end of we've made every mistake.
But it'd be more in the subjective area where, like the qualitative thing, working out whether this management team...
Or management lies to you. I'll tell you what, the team, I was in Adelaide today, in Melbourne today, Adelaide yesterday, and the team met with a company, and I won't name the company, and you'll know why I won't mention the company. But in the meeting notes that I read on the plane, I downloaded them onto my iPad, and then read them on the plane on the way back this afternoon. In the meeting notes, one of the CEOs said, I've been on a plane, I've just seen Wolf of Wall Street 3 times, and I think I've got some good ideas. Now, I walked out on that movie 10 minutes in. I thought it was horrendous. I took my wife to see it. She left after about 5 minutes. I left after 10. This guy's watched it 3 times. What does that tell you? It's just wrong. And so we meet with companies. We do make subjective decisions about them and about their moral fibre, about their whether they're putting shareholders first or themselves first, all those things, and we could make mistakes. And that's the reality. So far, we haven't made very many.
Okay, good. Let's go to that big order issue that the market could fall by 50%.
Yes.
What's your view on that?
Well, one of your viewers sent you an excerpt or a link to a website.
Yeah, Money News website was.
Mark Faber was quoted,
and a guy called Sean Hyman, I think.
Right.
Well, I didn't know.
I'll tell you a story. I was reading a Bloomberg item, an article, and somebody else was calling a big crash in the stock market. And this particular analyst had given a reason why, and that they'd done some research. And I thought, well, you know what, before I make any decision about this, let's find out about this analyst. So thanks to Facebook and Twitter and LinkedIn, you can find these people. So I typed in his name and the bank that he worked for, and I found that he's a recent graduate, and he's been at the bank for 2 years or 3 years, and he's looking at charts. and this is how he's reached his conclusion.
Okay.
So I sort of thought, well, all right, we'll park that one.
Yeah.
And Mark Faber, and with the greatest of respect to Mark Faber...
You got it right occasionally.
And occasionally you do. If you keep saying the stock market's going to crash, eventually it does.
Yeah.
And you were right. But, you know, for a long, long time, you've been wrong. And people have got to remember that in order to be a successful forecaster, the only thing that you need to do is forecast often.
Okay. Well, I don't want you to forecast, but what is your feeling about the stock market? I know you specialise in looking at companies, but if you thought that financial markets around the world had become crazy, would that make you sort of in your fund say, right, we're going to go to cash?
Yeah, but the question that you ask, the only way we can answer that is by sticking our wet finger in the air and see which way the wind's blowing.
Yeah.
What we do is we say, are there plenty of opportunities that are good value? Or are we looking at a market where there's no opportunities? Now, out of that process falls our cash weighting. So if we don't find anything that's high quality and cheap, and we've sold something that's risen well above intrinsic value, that cash isn't redeployed. We treat cash as a security, so it's another stock, and it's also security. Yeah. Right? So we think in the absence of good value in high quality companies, the only safe alternative is cash. So we've got about 25 in one fund, about 25%, in the other fund close to 30% cash.
But when you're supersonically afraid that there's no value and valuations have gone,
well, typically when that happens,
70 or 80%, do you think?
Well, in one fund we can be 100% in the Montgomery private fund. In the Montgomery fund we can go once every 6 years. I estimate it would happen. We go to 50% cash.
Okay. Well, just make sure you tell us before it happens.
Well, well, I will. And yep, no problem at all. I can do that. But we're not there yet.
No, that's what I wanted to hear as you say. We're not there yet. Mate, thanks for joining us on the program.
Peter.
Always great to see you. Have a great weekend.